Hello, everybody. Welcome back to the Mid Quick Rager podcast. I'm here today with a very special guest, Joseph Carlson, host of the Joseph Carlson Show. You guys probably know him on YouTube. I would say he is up there in the top 5% of people that are making finance and stocks content on YouTube that are trying to do it on their own outside of the media empire that CNBC is, these one-man channels that are trying to run it. I became a fan of Joseph about a year ago. I came across his videos just in my feed. Very relaxed voice for 20-30 minutes, just talking about the market very calmly, very easy to listen to and just understand. And I started getting hooked on his story fund, which is his growth portfolio that he is trying to grow and ultimately beat some of the other indexes. So Joseph, thank you for being on the show. I want to get started by asking, why did you start YouTube Finance? What was the motivation to upload content and become your own media brand? And how did you kind of get to this point?
Well, first of all, I appreciate the very good introduction there. Great introduction. Yeah, when I started YouTube, it was not that ambitious. So I can't go out saying I had this big master plan of how I'm going to upend CNBC. And that's still not my goal, really. What I wanted to do was, I've been financially focused a lot of my life. Like, it's just been a huge focus since the beginning. And I felt like I felt like I was okay with money for a long period of time, making it work for me and that type of thing. And I got into stocks, something that hadn't historically been in for a few years. And I was building up a portfolio and I was like, man, this is so much fun. And I'm telling people around me about this, like my wife, friends, trying to get them in on the same thing. Like, hey, you can invest in these companies. They pay you out dividends. This is literally, it's like legitimate free money. Like, there's so many things that are free money that are illegitimate, right? Like, this is a legitimate version of earning money without working for it. And I was so excited about it. I guess I was looking for an avenue to share my enthusiasm for it with a wider audience.
Right.
And I thought, I'll start. I did one upload of my portfolio onto YouTube, which is just an update. And I think the portfolio was at like 20,000 at the time. And the thought process behind it was simply, I did have some things that I thought about beforehand that I thought people would want. And the way that I tried to do it was a little bit of like, if I try to put myself in the viewer's perspective, what would I want to see if I was tuning in to a regular update or regular show about finance?
Right. Like,
really, what would I try to see? And I've seen all these great shows, but most of them are social commentary, political commentary. You have like the whatever, all these different, the different YouTube channels that are in the political sphere, right? And they're highly successful because politics is just, everybody's involved in it. In my opinion, those are entertaining, but they don't actually move people forward in life. They're not that like inspiring. They don't bring people together. They don't create wealth and commonality between people. They're actually quite divisiveness. Even though the people that run those channels oftentimes profit from creating outrage and constant fights, I just thought, wouldn't it be cool to have like the same type of thing, the same type of format where you can tune in and see kind of regular updates, but instead have be about finance, instead of it being very kind of like clouded where you don't have a lot of transparency, having it totally transparent, almost to the point where it's like a reality show, where you can tune in and say, hey, this guy, he's making these big bets on these companies, he's buying these, and I get to see week after week how this turns out, good or bad. And I thought from a viewer perspective, I'd be like, I would watch that. Like, if somebody did a show like that, where they showed their portfolio, real investments with transparency, and did it with continuity week by week, like a reality show, and give commentary on current events, that would be something that I would watch. So I created a show that was kind of like it had three legs of it. I kind of removed one of them, but it was originally portfolio updates, and I did that every single week. It was commentary on current events, and it was responding to the community emails and comments. And at first I didn't have any emails, so I just read comments off of my YouTube section. And then as time went on, I looked at kind of the numbers and the engagement, and I moved a lot of the responding to comments part as part of the Patreon because the engagement would drop off big time, but still people wanted that and stuff. So I just made that like, hey, if you want it, it's more personalized and stuff. But and then I kind of added on another segment, which is like really, I think, deep dive analysis into stocks. So that's kind of how the show started. It wasn't all that ambitious, but I did have some foresight in what I thought about. And mostly the thought was, really what would I want to listen to? Like if you're a YouTube creator and you're looking at what to create, you can't just look at what other people are doing. You have to think about it from your perspective. There are 3 billion plus people on YouTube every month.
500 hours of video uploaded a minute.
Right. So a lot of people think that's a lot of competition, but if you think about this for a minute, if you can make something that would be interesting for you, you're probably not all that unique. Like it's going to be interesting for at least 1 million other people if it's just interesting for you. But it's got to be something you would watch. If you're creating content that you wouldn't even tune in for, it's just not good enough. So that was kind of the focus. Is I'm like, I need to make this good enough that I would really want to look forward to this. And that was kind of the idea behind it. But I felt like I had a lot of advantages too. I don't think it was all skill or talent or anything like that. I was semi early to the financial space. Like
it was 2017 around, right?
It was 2019 actually. So
okay.
it was February of 2019. So really early 2019. I uploaded my first video then, and just immediately it was getting subscribers, like 300 subscribers a day, like right off the bat. So it just, it got spread around online on a few forums, and then people were like, just keep uploading, keep doing it. So I did it every week.
And what were you doing before you started finance? You mentioned you were a programmer, correct?
Yeah, I worked in programming for maybe eight or so years.
So software program was kind of your skill by trait. That was like what you were good at. That's how you're kind of making your money. And then you transitioned into finance on YouTube.
Yeah. So I would never just, my personality, very conservative. I'm like my dad in a lot of ways. Like I didn't grow up and I'm like, I'm just going to go full into YouTube and make that my thing. Like I have a family, I have kids. Right. I have to have a paycheck. Like I got to have something that I can rely on. And obviously, in my early 20s, I was figuring out what I wanted to do. I studied medicine for like a very short time. I say medicine, but I was going to go into that and become something in the medical field. Quit that real early. I'm like, that's way too service oriented. Like you have to be so patient and deal with people in person so much. I'm like, that's the wrong thing. But I had a brother that was doing that. And then I just went back and forth on different things. At one point I was going to go into law. I thought that would be interesting. And then I was like, way too much paperwork, like outside of the kind of depiction you get on TV, is just like a lot of office work. Right. And then I'm like, well, I'm good at computers, so I'll do that. And it was a really good choice because programming is, if you know how to use code and programming, I mean, it's obvious. Look at the investments, look at what runs the world. Like code takes over everything. So I went into programming, and luckily, even if you're a mediocre programmer, companies are so desperate for any talent that if you know how to do just about anything, you're going to find work. And so if you're exceptional, you'll get paid, dramatically more. But even if you're just average, you're going to have a very good career. So I did that for a while and just kind of progressed up the ranks. And that's kind of like, now I view it as kind of like a fallback. Like if YouTube doesn't work out, I have something that a trait I can go back to.
And those 8 years when you were doing programming, were you like also saving money and putting it into stocks, or was it near 2017, 2018, 2019 before you started YouTube? You were like, I'm a stock dude now. Like I love stocks and I just want to make more content around it. No,
it was gradual. So I started off and I wasn't focused on stocks at all. And that was unfortunate, I feel like, because at the time, my two favorite companies way back in, like 10 years ago was Netflix and Amazon. Those are like my two favorite companies ever, but I just didn't have investing in stocks in my mind. So I wasn't focused on it at all. I was focused on building wealth though. Like one of the first things I did back in 2013 was buy a home. I just had a strong feeling like I got to get in one, like prices are going to go up. And I bought my first home for $155,000. That same home today is worth around $400,000. So I bought it for 155x. Yeah, for real estate that it has all these advantages. You buy it without even your money, right? Right. So, anyways, I bought the home, and then soon after I bought that first home, I started up. I think the first thing back then was like in 2012, even a year earlier. Yeah, it was before buying my first home. I started an Acorns account. You know the Acorns app?
Yep.
I started one of those, and I was one of the beta testers of Acorns on iPhone. They released it on Apple and then Android. And I thought, I'll get into this. And I was just like obsessed with it, but I wanted to do more. It just didn't, you could only do their like pre-driven portfolios.
Right.
And I'm like, it's cool that you can invest in this modern portfolio theory, and it kind of like does the roundup and stuff like that. Then I jumped over to M1 Finance, where it had a lot of the same type of like long-term mentality as Acorns, but you could pick out your own individual stocks. And that's what I wanted to do. So soon after that, I started building that portfolio. That's the dividend growth portfolio that I've been building for a while. And then, I guess it got gradually started around 2012.
Last question about content creation, and then we're going to go into stocks. Patreon. I just want to know you seem to have a very successful Patreon. You've gotten people that are willing to subscribe to you for a monthly fee, which is just like beautiful, right? I mean, this is what software companies are obsessed with, this recurring revenue thing. What are your thoughts on Patreon as a business? Do you think it's friendly to creators? Do you think their 10% fee could be avoided by like a new crypto startup? Like, how do you feel versus YouTube ad revenue as well? What are your thoughts on Patreon in general?
On Patreon, the company. So you're wanting to know about my thoughts on Patreon, the company, or my Patreon?
Here's a better question. If Patreon went public, do you have enough conviction in Patreon, given your relationship with Patreon as a creator on it, that you would invest in Patreon? I guess that's my question.
Oh, yeah. I don't think they're doing enough to help creators for how much revenue I'm giving them. So how much money I'm running through my Patreon every month, and then the fees that they take out of that, and then the tools they provide as a value proposition for it, I think the value proposition they're providing does not match the amount of fees that they take out. Because, I'm giving them a ton of like, people look at the numbers and they do simple math. They're like, oh, well, he charges $10 a month and he has this many patrons. That is not the way you should do it. You got to know that they're taking out 12% of that. Then of course you have taxes on top of that. The amount of take home cash from it is significantly less, but regardless, Patreon charges about 3 or 4 times the amount that a normal payment processor like Stripe would.
Right.
So they'd charge like 3%, 2 to 3%. And if Patreon, it's like 8 to 12% after they add up all their fees. And in my case, my business isn't even run on Patreon. I'm running it mostly on Discord. Discord's providing. So if Discord was a public company, I would very much be interested in that one. Patreon, I think the value proposition is actually reverse. Like, I think they need to charge less to match the value they're providing, because they're basically operating as a well-known payment processor for creators. So they do have brand recognition.
Right.
That's their big value.
That's what I was saying. That's why you're using them, right? Because they're just the easiest way for people to pay.
It's simply to create less friction for users to sign up. They trust Patreon. If you send them to some website, josephcarlson.com, they don't know if they're on the right josephcarlson.com, right? Like, it's just a more frictionless way. But with people that have been around for a while, I have actually considered having the Patreon, but having another way that just cuts out an enormous amount of fees. So, in my opinion, it's beneficial overall. So it's a net benefit to creators, but I think that the value proposition needs to be improved for creators.
Got it. Yeah, it makes sense. I was just curious on your thoughts on that, given you definitely use Patreon. Okay, so some stocks of the hour. I want to talk about Palantir, Tesla, Netflix, and Baba. Palantir, the big one I got to start with first. You don't have a position in it. It's down almost 70% from all-time highs. Definitely was overvalued at $45. Agree with you. Should not have been a $100 billion company at that moment, 3 months after going public. But things have gotten back to earth, and they're growing revenues 41% year over year. I think it's very hard to find companies that are growing at even 25% year over year. Is there a world in which you start to get friendlier to buy Palantir one day? And what's the hesitation from buying it?
Yeah, so I know I'm in hostile territory here as a non-Palantir shareholder. So my thoughts on it are, obviously that was an easy call like last year. I mean, in hindsight, it's easy, but in reality, it wasn't just Palantir that fell. Like almost every speculative stock, and I don't mean speculative in a negative way. I just mean high-flying, high-multiple stock came down. When I look at Palantir, I think, let me just outline a couple thoughts on it. So the company, I like the industry that it's in. I like the leadership of it, Peter Thiel. I like the fact that it's kind of a monopoly. Obviously, I like software. I think that code is like the future. A lot of the story fund is based on that. The valuation has come down to much more attractive levels. I think it's at like a 15 price to sales right now or something around there. Yeah. It was at a 40. And my basic message was, back then, a year ago, I came out with the video of why I'm not buying Palantir, and the basic message was when something's trading at a 40 price to sales, you just don't have like the valuation safety. Like you don't have that in the stock. So it's got to like crush it and everything has to go perfectly. And even then you don't have a ton of upside support. So that's the same case with a lot of them though. Like I've kind of exited out of all of those. Once I saw, these, like a couple of them, the dominoes tip over, I'm like, the market is not rewarding this risk anymore. So I exited out a lot of those, like DoorDash, Snowflake, CrowdStrike, Atlassian, and those were good companies to exit out of in 2021. So, right. But anyways, with Palantir, I think my big reservation, the reason that I haven't bought into it is not really concerned about valuation. In fact, I think the company is okay valuation right now. It's just when I look at the investments that I've stumbled on, it's been ones where I feel like I'm investing in more of an abstraction. So I'm investing in something where I'm investing in a concept or an idea rather than something that like I for sure know exactly the ins and outs of everything. So if you look at the investments that I've done well on, and this is my personal like portfolio kind of history, I've done really well on Apple. That's a company that I bought when people are saying it was overpriced at a 20 PE ratio. Now it's up to like almost a 30, right? So I got multiple expansion and the earnings have been great. But it's like I have an iPhone. I use all their products. I know exactly how all of it works. Costco is another one that's been really well. Like it's done really well as an investment. But I know like so many people that use it, and they're just emphatic about the value proposition that company provides. Other companies, that have done well in the past, I try to think about. Another one that did well is Atlassian. That's one that I purchased and went up. And it's just like project management software. But I've been leaning more towards companies that I feel like I just have to know exactly on a base level what I'm investing in, not an abstracted layer of third-party explanations, third-party descriptions, kind of a layer of a third-party analysis on it. Like I have to know for myself what it is.
Is that for your personal investment conviction so you can sleep well at night? Or do you think, just to be open-minded for everybody, there is a massive arbitrage opportunity if, yes, you can't see the software, but if you've done like the deep digging, the software is doing well, but obviously you can't touch it because it's not. Like, do you think personally from an investing mindset perspective, look, I don't get it. Maybe there is an arbitrage opportunity, but if I don't get it, I can't sleep at night and hold if the stock is bad in 2 earnings.
Yeah, so I think so. Obviously where you get like outperformance a lot in many cases is when you do a deeper dive and you understand something that the rest of the market isn't willing to understand.
Right.
And I think that could certainly be the case. I just have to be 100% confident myself, because I realize when I make an investment into something, like if I go public and I go really heavily into that company, I know a lot of people will follow suit, right? Because if you get a channel that has a lot of views, like you do have influence over people's decisions. So I just have to have something that I'm very certain of, at least the company's value proposition, their competitive angle, like what the competitors are, like how the company's doing, not just on a quarterly basis, but kind of like how things are going. Like I can go and assess, I can use Apple's latest products and say, even if the quarterly revenue is okay or whatever, I can say this product is, like they're not iterating the same. They're not doing the same things. I can assess it with my own hands, right?
Right.
The same thing if I'm investing in, like Starbucks or Domino's or any of these companies. I look at a lot of investors. You have Warren Buffett saying, your circle of competence, basically saying, don't venture out into things where you have less of an understanding of it. You have Peter Lynch saying, buy what you know, right? Buy what you know. You have an edge on something. If you really know it, buy it. Bill Ackman emphasizes simple, predictable. That's his investment thesis. Like he invests in companies like Chipotle, where they have a box, they serve burritos, and they open up more of these boxes by the thousands every year. So I just see a common theme of all of them buying simple, predictable, well-known businesses that can replicate a business strategy really easily. When I look at Palantir, I'm not saying they can't do that. I'm just not 100% confident myself. And if I'm not 100% confident, I will still be willing to invest in it, but it will be a much smaller position, right? I will kind of be in like the speculative basket. Like I'll have it as a smaller holding. I'm never going to put like 30% of my portfolio in it like I will with Amazon or something. So it's just that layer of abstraction. With Palantir, I feel like I've never used the product.
Right.
I've never even talked to anybody personally that works at a company that has used the product and it's like, this is a game changer, right?
And it's different from Atlassian because that's project management software. I don't know, maybe you used it, maybe you didn't, but
it's the industry standard.
Right. And you know what project management software is, but you might not know what B2B data analytics, AI, machine learning at the edge is. Like, it's just.
Yeah, no, Atlassian, you can ask people working at big tech companies and they'll say that, Jared, these type of things are like the industry standard across the board. That's why they grow substantially without doing advertisement. Right. They have minimal marketing costs. So it's a fantastic company. The valuation went too high. So I sold and locked in some gains, but that's an example of one that I'm very confident in the industry that product isn't going to get upended anytime real soon.
Right.
And, so I guess with Palantir, it's kind of for me, it's in the basket, like Monish Barai talks about, the too difficult. Like, it's just kind of in that phase of too difficult for me. In terms of being confident in it. I just feel like it's too difficult.
Cathie Wood took a $400 million loss on the position. What are your thoughts on that? And I guess that kind of segues into what do you think about Cathie and Jet? Let's talk how do you feel about Cathie's arc?
I will say that I think it's disappointing that she holds companies and buys and buys and buys them down and then dumps them at the absolute bottom. I just think it's a very, it's just disappointing. If she's going to cut losses on the company and change her perspective, she should try to do it early on, right? And what I've seen from ARK is just an almost brazen unwillingness to protect any capital. Like they're just stubbornly unwilling to do any type of, I don't know, like, we actually just did some analysis on ARK Invest. I was looking at it, and I think they'll have to have 125% returns to get back to their all-time high.
Yeah.
So it's very difficult. I actually did a poll on this, which is more important than opportunity cost or protecting the downside. And the majority of people by a small margin said opportunity cost. That's more important than protecting the downside. I disagree with that for a couple of reasons. If you lose a lot of money, like if you just permanently impair capital, meaning you've lost it, it's not coming back, you sold positions at an enormous loss, making that money back up is much more difficult than not losing it in the first place.
Right.
And any investor, like value investor, like Michael Burry and ones that have been highly successful, they say that margin of safety and protecting downside is paramount. Because if you invest in good companies and the downside's well protected, the upside will take care of itself. And what I saw her do was when things were getting to ridiculous valuations, I didn't see any effort to lock in any gains on companies that were traded up so far past their historical valuation. I actually came out with a video. I don't know if you caught this one, but I came out with a video a year ago. It's probably one of my most successful videos. I think it's the second most watched ever on my main channel. And it was called A Warning to ARK Investors.
Yes. I did.
Right. And the first half of the video was basically me acknowledging the success Cathie Wood has had and acknowledging how she's defied skeptics with, like, going on to CNBC and acknowledging, people saying that Tesla is a bad buy, and she held true to it. But then the second half was showing that this cannot go on forever. The ARK Invest in 2020, that was doomed to fail. The valuations of those companies were beyond their historical highs. They were 200% above their historical norms, if you look at them. And the data shows whenever that happens with a fund like that, the next year has very poor returns. And so I think that was probably one of the most accurate videos I've ever came out with. It was probably like my best timed, like, single video on a subject I think ever. So it wasn't.
And the worst part is most people were buying ARK at 140, 150 because there was.
Well, that's what I was trying to warn people about. I was saying, look, it's raced up so much already. Like, look at what good investors do. The genius does at the beginning what the fool does at the end. Like, you can't chase the returns of something that's already gone up 200% and it's trading at 50 price to sales. Look at the multiples that Zoom was trading at, and we're in a very unique environment. But I think that investors were just looking at it and they think, well, it might go up another 100%. I just think that's such a dangerous way to invest. So, I wasn't trying to criticize her, but I just think that when she went on to CNBC and the attitude she had afterwards, even it did lower my view of her, because at first I saw her as just optimistic. But then I saw her as kind of like, I don't know, when she was on CNBC and she's explaining that she wouldn't change anything and the companies were great value back then a year ago.
Yeah.
Clearly they weren't. Like, they weren't great value. They were way overvalued compared to other potential investments. That means that you didn't protect any downside. You didn't think about the valuation. And I thought it was extremely dismissive. It wasn't introspective at all. She didn't admit any fault with anything. That kind of lowered my view a little bit. But now I remind people, like, Arcus came down so much. Like, now that nobody wants to invest in it, now is probably a better time to invest in it. You have to think about that as well. So, with her selling Palantir at a loss, I don't like the way that she trades. I don't like seeing the daily emails of her doing 52 different trades a day. I don't think that's a good way to invest.
At first, I thought it was about transparency. Then I realized, wait a second, this is marketing. Because if she's buying the crap out of Roku, a lot of people are going to follow her. I mean, you talk about a YouTube channel with influence. I mean, their collective media presence is probably in the tens of millions.
It's so much marketing. That's another thing is, she markets her fund like crazy, which I don't have a problem with that, but it's just you got to look at incentives. So, every YouTuber has incentives to get clicks on videos and make money doing it. So you got to put in shocking headlines, but sometimes like the most mundane stuff is actually the most interesting. So there's conflict of incentives in YouTubers, certainly. I'll admit that. But look at big money incentives. Cathie Wood's major incentive for her and her business is to get assets under management, to attract assets under management. And the way to do that is through marketing, through driving narratives. They're saying her companies are going to annualize returns at 40% year over year, right? She promises things that I think are just shocking to say to people, that her fund's going to get 40% annualized returns after going down 70% in 1 year, right? So, and then I look at other incentives. I wonder why she considers things that I think are ridiculous. I completely disagree with her on things like the fact that she considers Zoom and Teladoc. I'll give her Tesla. Tesla's an incredibly innovative company, right? Flagship company in the innovation fund, that fits. But calling Zoom and Teladoc and DraftKings and Robinhood, putting them as top holdings or whatever, or even in the top 10 of an innovation fund above Amazon, above NVIDIA, she's really going to do that with a straight face and say that those old companies, Amazon and NVIDIA, aren't as innovative? Compare what Amazon does in a day at AWS or their logistics or their robotics, right? Compare that against anything that Zoom is doing. Yeah. Even compare what Microsoft is doing against what Zoom is doing. And so it's marketing. The problem is, if she has a portfolio full of big tech companies, she
becomes a nobody at that point, right?
Yep.
She becomes like everybody.
No distinction. So she can't attract funds, because if you have big tech, you might as well buy QQQ.
Right.
And so when I look at my story fund, the companies I have in that, I have Amazon is like almost 30% of the weighting right now. I consider that far more innovative than about half the companies in ARK Invest right now, about half the flagship companies. And I think that could be very easily argued.
Right.
So I look at it as a lot of marketing, but we'll see how she does. They're not bad companies, by the way. Zoom and Teladoc are great companies. The point is, they're not as innovative as a lot of companies out there.
Right. You talked about companies that you like to invest in that are simple and predictable. One of the companies, I think one of the biggest companies in the world that to me is the most simplest and predictable in terms of predicting its growth and revenue is Alibaba. It's a very simple business at the end of the day. It's not that complex, a lot of technology involved, but at the end of the day, we know what the story of Alibaba could be, and investors had faith in it about 2 years ago. But as a result of the past 2 years and what's been going on with the Chinese government, there have been a lot of headwinds. So can you tell me your relationship with Baba? When did you start buying it? And has your narrative or thesis changed? And is it a buy right now for you going forward?
No, I think, so how I got into it is like, I think most other investors that bought into it. Basically, if you just do fundamental due diligence on Alibaba and break down the company, It's one of the best companies in the world based off its revenue, free cash flow profile, market position, the assets that it has. Ant Financial was going to IPO and be a massive financial that would have a lot of returns. And basically everything that could go wrong went wrong with the investment. So the Ant Financial blew up. That's something that just value destroyed, like a ton of value. It was going to be the biggest IPO in the world, and it blew up because the Chinese government didn't like what Jack Ma said. So he mouthed off to government officials. That was kind of like strike one. Then you had right afterwards, and entire, you could overlay a stock price chart of all of this going on, and it's just going down the entire time. But then the second thing happens, which China decides it's time to regulate, right? Not good when you make an investment in a company, and then the government, which is a dictatorship, all of a sudden decides they're going to regulate companies and implement a bunch of different rules. So they're like delisting companies in the US. They're simply, I don't even know what they did. They just like banished companies that did tutoring and online tutoring and schooling. They went to Tencent and said, hey, kids can only play 2 hours of video games a day, right? Or they can only watch like TikTok for 2 hours a day or something.
Right.
They're doing all these crazy regulations. And of course, that's not good in investors as an investment thesis. So that happened. Stock price continues to fall. And that was kind of the big news. And I'm like, all right, well, the story is deteriorating here. Like, I'm just acknowledging it. Like, the story's kind of falling apart here. It's one thing after another. And then it continues. We have a war breakout in Europe between Russia and Ukraine. And wouldn't you know, that happens where Russia is more of a friend to China than the US. They're kind of more friends with each other than the US. And obviously, there was already kind of issues in China between the US with COVID and their policy. They shut everything down and whatnot. So it basically evolved from one macro concern of just like a good company, but it's in China. And my thought process at the time was we do a lot of business in China anyways. Like Tesla has, I don't know, like 20% of their sales in China. Disney's in there, Nike's in there. Lots of companies are in China. So I didn't think it was like an end all. But with the geopolitical risks that have risen between Russia invading Ukraine now, it's made investors even more cautious. They don't want to invest outside of the US. So I look at it as just compounding concerns driving down the valuation. I think it does affect the story. I wouldn't promote investing in China right now. I just think the risks they've compounded way too much. There's way too much
uncertainty. Have you trimmed your position in Baba, or are you just holding and waiting?
I've not trimmed. I've just held it. I just held it.
So a part of you believes it'll come back.
Yeah, I do. It's just so risky. Like if you're doing it, it's one of these things where it's like, even when I was first investing in Alibaba in China, I was like, no more than 10%. Like I'm not doing that more than 10% of my portfolio because it has country risk. Like they could just shut it down or delist it and I'd lose money. So I can't go all in like I could like an Amazon or something that just doesn't have those type of risks. But now the risks have just gone so out of control that even though the fundamentals might perform well, the price moves up because of supply and demand. People want to own the company. And so unless China becomes a more attractive place for investors to invest, I just think it's going to be a difficult road. But right now, I feel like the valuation of Alibaba has fallen to levels to almost reflect that risk. So if it hadn't fallen quite as much, I'd probably be taking some out. But the fact that the price has already declined so much, I'm like, it's still at a point where I think I'm just going to hold on to it.
Now, you're not one of those investors that's like solidly in the value investing Munger Buffett camp. But yeah, Munger did put in $72 million in December into Alibaba. Does that give you any reassurance? And he put, I think it when it was a 120.
Yeah.
Does that give you any reassurance that like, look, Munger's doing, I mean, Munger can afford to take that loss, but if he's doing it, like he must know something about the company.
Yeah. I look at it this way. It is a positive. He's very positive on China in terms of, he highlights some good points. Like they're growing their economy like crazy. Like you look at the skylines and they have big buildings now and they have big cities. Before it was little, it wasn't as quite industrialized. Like they're growing their economy rapidly. We do a ton of business with them. I think that China and the US, like I look all at incentives. Like we have incentive to work with each other, even though they're a dictatorship, even though we're free market, they still want to grow their economy. And the US has a lot of money that we can help do that with business, right? So I look at it from the incentive that they're not going to want to destroy their biggest businesses. Like that just
Right.
doesn't make sense. They're not going to want to
It
crush
doesn't make sense
Alibaba and
at
Tencent.
all.
Yep. So that incentive plus Charlie Munger saying, I'm putting my money in it, at a time it was kind of like, oh, the people scared of this are silly, right? Like buy when other people are being fearful. That's the place to buy. But like you look at their history, Buffett's been wrong before. Charlie Munger's been wrong before. If you look at, they made many failed investments. But if it turns out it's a good investment, they make a lot of money. So I'm not going to go all in on it. Even if Charlie Munger does, even if another big name investor does, I will limit my risk with it because I can't have my long-term portfolio completely determined based off of what China does. I just am not willing to do it.
Right. Okay. Is Tesla overvalued?
Tesla overvalued? No, I don't view it that way. It's
Do you own Tesla?
No, not right now. Okay. I have, a lot of people don't know this. I did own some Tesla. It actually went up at like almost 100%. So I can't remember. I bought it at like 400 and it went to like, 780 or something like that. And then I'm like, all right, I'm going to cash out at this point. And since then, I just haven't been in on it. I was going to be buying more of it in the story fund once it was dipping just recently. And I was like, if it falls below 700, I will buy it. That's a price where I know the positive expected returns are very good.
Right.
And it just went above that. So maybe I should have had a little bit more leeway there and been like 750, 780, I'll buy it. But right now, I think it's more probably just like fairly valued. I don't think it's necessarily way overvalued. I think it's mostly fairly valued, but it's almost like the outcome of it is just more unpredictable. So if they come out with like a really full self-driving and robo-taxi network and stuff, then it's probably severely undervalued right now.
Right.
But if that just keeps getting delayed year after year and competitors slowly start gaining market share, and then there's less that distinguishes Tesla over a long period of time, then it might be overvalued. So, it's just stuff in the future that I'm not positive on. When I look at options, I look at Tesla, I look at Amazon. I like the value proposition of Amazon more, just because I think it's more predictable. That's the only reason why.
Do you think Tesla announcing a stock split deserves to get the same market cap of like GM and Ford in one day, 84 billion? Like things like that, they don't scream like overvaluation to me. It just screams a fanatic cult-like following that I think you and I talked about that is keeping the stock high, even in a world in which most professional investors may think, look, $1 trillion is just not enough to justify for the output that they're putting, unless you believe in this sort of robo-taxi story. So I guess my question is, do you believe the cult of Tesla is able to get it through the next couple of years with little news updates like a stock split?
Oh, I don't doubt it. They have super high conviction, long-term followers. I know, there's some people that have $1 million plus a Tesla. It's like their whole life savings. They won't sell the stock no matter what. So I think very much there's a huge supporter base of shareholders. In terms of the stock split, a lot of people scoff at it. I'm actually kind of on the side where like, I know the arguments. I know it doesn't create value, right? You're just dicing something up into smaller bites. But again, if you look at the way people buy and sell things, putting it into smaller chunks makes it a little bit easier to do. It creates less friction, right? Yeah. And also, stocks are driven by perception. When you have something that's a smaller piece, you can buy a little bit more of it. I think it does affect the inflows and outflows of money. But I don't think it should be like part of your thesis or long-term thesis. I think if you own the stock, you can be like, all right, this might be a little short-term catalyst that will help it out, but it just shouldn't be viewed as a value proposition or major piece of a thesis for a stock. AMC, or which one is it? AMC did its stock split, or they announced one?
No, not AMC. Amazon and Google did, from what I know.
I'm pretty sure.
Oh, they did?
I'm
AMC?
pretty sure. I think so. I'll have to look that up. But yeah, and it's just a reminder that any company can do it. They don't have to have a high share price to do it. With Amazon, I think it makes sense because their share price was over 3,000.
I was just about to ask. So like one of the companies that benefited from it was Amazon, that's doing a 21 stock split. And again, I want to transition. When did you start kind of buying Amazon, and how big of it is it of a percentage of the story fund?
It's about 30% of the story fund right now.
Okay.
So I've dramatically increased the position. So I started buying it more. I started doing research on Amazon. There's a couple of people in the Discord that are very bullish on it. And they're very smart. They work for these type of companies and stuff. But I look at the company And the big thing with it is like the PE ratio, the price to earnings, right? And Tesla investors will know like the price to earnings is based off of the next, if you're looking at forward basis, makes up the next 12 months of earnings. But if a company can grow its earnings substantially for a long period of time, having it at a 50 or 100 PE kind of makes sense if it's going to grow its earnings 3 times faster than other companies. And I look at Amazon as a company that the basis of my research is basically that over the next 5 to 10 years, I think just AWS alone will be more valuable than Amazon's current market cap.
Yeah.
So I look at it as having essentially, and I can't say for sure, but in my opinion, it has very limited downside if you hold it over a 5-year period, because just the way that AWS is growing, it grew revenues 40% last year, 40%. It has a revenue run rate of $70 billion, margins of 40%. And it's, it's not going to grow at 40% year over year forever, but that company, just with the price to sales of 10 is a $700 billion market cap company just for AWS.
Right.
Now, that's a lower price to sales than most software companies. It should be, in my opinion, it could have a price to sales of 15 or 20 based off of its future. So right now, I think AWS is worth about 80% of the total value of Amazon, just alone. And then you have the marketplace with 200 plus million Prime members. You have that just Amazon Prime generates something like, it's going to do about $40 billion of operating income.
Right.
And just high margin Prime membership income, right?
Amazing pricing power. Yeah.
Yep. Then you look at the business they basically just invented over the past 3 years, which is their advertising business. It did more revenue than YouTube.
Yeah.
So YouTube did about 33 billion. Amazon is going to do with their ad business just on Amazon.com about $40 billion this year, give or take. So you have 3 businesses, 70 billion run rate for AWS. You have Amazon Prime subscription business, and then you have the ad business, and then you have another $400 billion of revenue beyond that, which is their retail business and their logistics, which they're so far ahead of their nearest competitor like Walmart or Target. It's not even close. They're not even ballpark close. And so I just don't know how I lose money on the company in 5 to 10 years. I don't see it would have to have multiple aspects of the business crumble. It could happen, but I think it's incredibly unlikely. So yeah, I started buying more and more of it, learning more about it. The valuation is what throws people off because of the PE ratio. I think that Amazon's doing a ton of things that are, it's basically like you look back 10 years and it's like Amazon earned, they do this thing where they kind of game the bottom line of the company. Like, we're not earning money, but that's because they take all of the money and they just put it back into new investments.
Yeah.
They're just, when they open up 300 plus warehouses a year, they're buying planes and ships and thousands of vans and hiring tens of thousands of new employees. They can make it look like they're earning no money, when if they tilted things to profit mode, all right, we just want to raise profits and generate margins, right? Higher margins. I think they're going to be incredibly profitable. So yeah, my conviction's just grown over the past few months as I've learned more about the company.
Got it. Last thing I want to talk about, Amazon, which is a company that's 30% of your portfolio, relatively, I would say within the last 4 or 5 years, released a product called Prime Video, in which there's like, all right, we have 200 million people. Let's just throw a bunch of content at them and let's hope they watch some of this stuff. And this competes directly with something that you were very bullish on, something that you were buying at $600. You were like, I'm with this company, which is Netflix. Now, I don't know if you know this about me, but I wouldn't say I'm a big bear on Netflix. I just fundamentally disagree with the thesis that Netflix has the ability.
Sure.
I don't think it should be a thing. So I want to lay out my thesis, and then I want to ask you a little bit of questions. And it's just like a 1-minute thesis on how I think about Netflix.
Sure.
I think about Netflix as a media company at the end of the day. I don't see them as a technology company. Now, if they do this video game platform developer stuff, maybe it becomes more tech, but I see it as a movie theater inside your house. They have a recommendation algorithm, which I guess you could say makes it technology, but even that recommendation algorithm in comparison to something like YouTube, I think is like, it's apples to pears. I mean, like YouTube has your search results, your click history. The AI actually knows what you care about. just through predictive simulations. Netflix has content inside of Netflix, and it has to dig through that content that hopefully it will give to you. And until they have a new release, there's nothing really new to recommend to you. So I'm not bullish on Netflix's recommendation algorithm. I'm not bullish on the fact that they spend $20 billion a year just to get content, and that content dies out very quickly. I mean, they spend all this money on Don't Look Up, a great movie, awesome movie, but now no one really cares. They get a new show. All right, you put that new show, it's binged in like 3 hours or like 10 hours. Now that's gone, right? So now what do I watch? Whereas YouTube, you have constant videos coming per minute. YouTube has a harder time finding good content because you have the world uploading a lot of shitty videos. But Netflix, I think, has a problem with getting a lot of content because they have to constantly make the content or license the content to ultimately get it onto the platform. So when it was at $700, I just felt obviously everything was overvalued, but when it got down to 300 and 350, I was like, okay, it's a little bit back to normal. But now that they have something like 80% of US households or something, and now they're looking international to expand, it seems very weird to me that Netflix would be growing at 20, 30% year over year in terms of households when you factor in all the competition with HBO Max and everything else that exists within Netflix. And then my final bear thesis is I just don't think the content is that good. Personally, like and maybe that's a personal, right. Bridgerton does not turn me on. So I guess my question to you is, like, you're a very sound, logical person. What really is the bull case for you for why you think Netflix can become this behemoth company? I know Bill Ackman got it. I don't understand that. I can't really comprehend why he did that, but why do you think he bought it? And why are you continuing to buy the stock?
Sure. Well, just to clear one thing up, Bill Ackman did buy the stock after I was already in it. So this wasn't a follow Bill Ackman into it.
Yes.
I kind of followed Domino. I kind of followed Bill Ackman into Domino's. I did not follow him into Netflix. But to back up a bit, some of the things that you mentioned, the first thing is companies that I think provide a lot of value, and they somehow have a way of getting customers to stick with them for like over a decade. And they continue to have that type of, loyalty of customer, I think is a good indicator to begin with. Like, I look at Netflix, and I first signed up for it, I think I was in college, like 10 years ago. Yeah. And I've been a subscriber to it for that entire time. So the lifetime value of a customer, I consider to be very significant if you get someone that gets into something like that, and then they can just keep you month after month for 10 plus years. And I think there's only a handful of companies that are doing that. There's Costco, there's maybe Spotify, there's Netflix, there's Amazon with Amazon Prime, but that lifetime value of a customer, I think, is significant. Now, you look at what Netflix has done over the past 10 years, right? Since 2017, they launched their streaming service, and they were going against every big media company that were infinitively bigger than them. They licensed their own content, and they weaponized it against all these big tech companies, right? And Disney and Comcast. And with about $17 billion of capital, that's how much debt they had. They literally surpassed all those companies at their own game,
right?
Creating a global subscriber base of over 200 million subscribers at a very high revenue per user. And they did that with $17 billion, which is minimal. I mean, these big companies are competing with are huge. The leadership of Netflix has so much foresight and so much long-term thought in what they're doing that early on they realize that soon enough these companies like Disney will catch up, and they'll take off all their content off of Netflix because they know that we're going to become bigger than them if they continue to do this. And sure, what they did was Ted Sarandos, he's the co-CEO now, but he's been a significant part of Netflix since the beginning. He realized that this was happening, and he went to Reed Hastings, and he's basically like, hey, we got to start creating our own original content because we can't be reliant on theirs. They're going to pull it after a certain amount of time. That's when he greenlighted House of Cards, was like their big first hit.
Right.
So they start building up their original content library, and it makes up a bigger and bigger percentage of their spend over time in anticipation of competitive threat of these Comcast and NBC and all them making their own streaming services. Now, the situation they're in now is, I think one thing that actually worked against them, it was more detrimental than helpful. At first, it looked helpful, which was COVID. Because, we're stuck at home, Netflix is going to crush it, right? That's so good for Netflix. They gained 20 million subscribers in one quarter, right? How great for them. Not great, because what they were doing was sneaky beforehand. They were doing it on pace, building out their own business. And COVID basically told every other company, hey, you have to become Netflix right away, right? So it actually sped up and attracted more competition from the other companies. So Disney's like, all right, we got to put all of our content on Disney Plus. NBC's like, we got to create Peacock and so forth. But anyways, I actually think that was a detriment to Netflix just because of the competition it attracted. But I look at the situation Netflix is in now. In my opinion, they've always faced a lot of competition. The way that you can tell if competition is really affecting them is by their churn rate, meaning are people canceling Netflix to go to other options? And what we've seen so far is that their churn rate remains the exact same. It hasn't gone up at all because people are leaving cable TV. They're freeing up $80 to $100 a month. And they're going, I'll keep Netflix and I'll add on HBO for 3 months and watch their series. Then I might watch Disney. I'll sign up when the new, the new show comes out on Disney I want to watch. I'll sign up for a couple months and watch that. But Netflix seems to have this position as being kind of the centerpiece of it. And it's not the one that people go to cancel, which makes sense because you say that their content expires quickly, which is true, but they have more content being recycled through their service than any other.
Right.
So they recycle content, or they rather iterate their content and come out with new content at a much faster clip than Peacock.
Yes.
Like Peacock's going to continue showing you every time you log in, they'll show you Parks and Rec and they'll show you The Office.
The Office.
Because it's like, that's what we got. We don't have anything new. We got to show you the same stuff, right? That's going to be it, right? And then they'll try to have their like news shows because that's actually new content. But Netflix, every time you log in, almost every day, it's going to feature like a brand new series. Right. That's because they come out with 150 to 200 individual episodes per month, which is on pace of about the rest of them combined.
Right.
So the value proposition is still pretty good. I realize that, in my opinion, Netflix is the big, and the criticism you have is shared by me. The big problem they have is they're not good at making movies like Warner Media. I was watching in fact, last night I was watching a Netflix movie called like Bubble or something like that. Okay. And it was some about actors, like, I don't know. We stopped watching it after like 10 minutes. And then I went on to another Netflix show, which was, I can't remember the name of it. Blade Runner. But it wasn't a Netflix movie. It was a Warner Media movie that Netflix is licensed. And I'm like, This feels like a movie. This is fantastic, right? And so their movies just aren't great. They need to get better at that. I just think it's something they need to improve. But they're coming out with like a movie a week. I think they will get better. In fact, I really think objectively they are getting better at movies. Right. Like Don't Look Up was a better movie than, ones they were coming out with 2 years ago. Right. So, I think that the big thing is if churn rate started to go up and people were leaving to other platforms, then I'd be more concerned. That hasn't happened yet. Another thing to keep in mind is that their margins have gone from roughly 6% in 2017 to about 26%.
I don't know that.
They were their debt. If you look at their debt levels quarter by quarter, it was climbing up as they're using debt to fund more content aggressively to get ahead of this big shift in, with other companies competing with them. Now their debt's completely flat because their free cash flow profile has improved. They actually did share buybacks. They're going to be continuing to do share buybacks in the future. So they have enough subscribers now and enough revenue that they're actually funding the growth in their content completely through their revenue, not through any debt, not through issuing shares. So they're no longer diluting shareholders. They're no longer issuing debt, and they're actually going to generate positive free cash flow and be doing share buybacks. So there's a lot of fundamental improvements. I look at it and I did some like just, discounted cash flow analysis on it. My estimation is that they'll make around low end of $30 of earnings per share in 2025. That was my estimation on it. So I think they'll put it at like $950, around $900 a share. But that's my estimate.
It's massively undervalued. That's what you're saying.
Yeah, I think so. Now, because something's undervalued right now doesn't mean that events will unfold in the future that won't change it, right? The big thing that investors are concerned about, like if you looked at the reason they sold, was their first quarter, they were expected by the street to give guidance of like 5 million subscriber gains globally. Right. And they came out and said, we're going to gain 2 million. Right. And when you go from 5 to 2, when your growth rate goes down more than 50%, 20% drop in the stock.
But I guess that's my question. If that's their guidance, do you think that's going to get bigger? Or do you think they're going to stay flat at 2-3 million a quarter just because of how big they already are?
If they stay flat at 2 to 3 million a quarter, the company is probably overvalued right now. That can't be the story, right? Because the idea behind Netflix is that if you take out China and Russia, there's like roughly 800 plus million households, 800 to 900 million that don't have Netflix. And that's like across all the countries that they can do business in. And they're currently at 222. So they have a huge total addressable market to naturally grow in. And the nice thing about Netflix is, unlike Disney, where they make content in the US and try to market to everyone, right? Not every culture loves the exact same content. Like Netflix is making these South Korean shows,
Yep.
Like Squid Game, that become international hits.
Right.
So they already have studios and relationships all across the world, and they're trying to figure it out, but they're having trouble. In Latin America, they had trouble last quarter. They were expecting higher growth, and they're just saying the growth has slowed down. They think it's because, like in the US, we're kind of over COVID. Most of us have money. We can afford Netflix if we really want it. You go into poor countries and like their economy is still kind of crushed by it. A lot of them don't have a ton of discretionary money. So they have to have jobs and be working to be able to afford something like Netflix. So I think some of the struggles are temporary with Netflix, a lot of them with international growth. In India, their content strategy is also like they're just trying to, like a tech company, they're iterating, trying to figure out the content strategy in India because they're not getting the signups that they wanted. They're hoping to have about 50 million in India by now, and they don't. They have like a few million. So they lowered the prices to be more competitive. They're just trying to scale. And I think they'll figure it out. So I look at it too as like long term, every single year without fail, thousands of more people, millions of more people cancel cable TV, right? So it's just like a slow churn of cable television. And there's streaming companies that are going to take advantage of that. Within the streaming companies, I think Netflix will be one. And then the companies that you bring up that are big competitors, Amazon and Apple, these companies I think will be ones as well.
So what I'm hearing is the bull case is like Netflix has such a first mover advantage in the streaming place and such a competitive foothold just from a brand recognition perspective that even the companies I mentioned, which HBO Max and Amazon are there, I don't think they have anything on Netflix, is quite frankly speaking. They're threats, but it's Netflix. Yeah. It's Netflix. Like your argument is, and I love the point you said about canceling. It's like when you think about canceling, I would cancel HBO Max tomorrow. Like I don't care, but I know like my parents wouldn't let me cancel Netflix, right? So like you're not going to cancel Netflix. So if you're not going to cancel Netflix, that's there. And then number two, if they're getting better at making these don't look up type of movies weekly now or even monthly, then they're going to have really, really strong, just like top of the funnel brand awareness to get people into the door and sell them this subscription. Last thing I want to ask you about is premium content versus user generated content. Like, do you think YouTube and TikTok and user generated content ever is going to be able to outpace this type of premium quality stuff people want to watch when they get on their couch?
Yeah. So when you compare Netflix, first of all, to Google or to Amazon, I think Amazon and Google and Apple are better investments. That's why I am so overexposed to those companies. So they're weighted huge in my portfolios. I have a ton of Apple. I have a ton of Amazon. It's my biggest holding. And then I have more Google than I have Netflix. So when you're comparing, like if the argument is, well, Netflix is good, but it's not as good as big tech, that argument is shared by me. I don't think anything is. That's why I have a huge portion of my portfolio in it. I could go all big tech, but I just feel like that's, I want to diversify a little bit into second and third best bets, right? But I look at Netflix and compare it to user-generated content. I think it will always be different. So I think people want both. There's obviously, like YouTube, the amazing thing is they just have the platform. The users generate all the content, and then they, you barter for ad space on it, and then Google makes all the money while just running a platform. So they obviously have an incredibly good business model. But I also look at YouTube as YouTube creators will continually, as the economics improve of YouTube, like think about how much money creators are making on YouTube, right? It's this huge opportunity to build a business, and you can do it with almost no startup costs. Like you can just start uploading videos. With that type of opportunity and the real economics working to support full-time work and hire employees and editors and, lighting people and stuff, like to do it professionally, I see YouTubers continually reinvesting more and more into production and it becoming more and more upscaled. Like, I've even done it myself. Like I got nicer camera and spending stuff like that. Like, I see you 2 years from now, you're going to have your own huge studio and a production team. Like it's just going to happen as channels grow and they gain more followers and you get more money. You're going to see the production increase. So I'm very bullish on Google and YouTube. But I still think
you think there's a different offering that people do when they sit on their couch. They're not pulling up YouTube. Like they want a nice premium offering like Netflix.
Right. So I think that people, they want it all. Content is huge. They want the very short-term mindless content that they can flip through their phone when they're eating a breakfast or whatever, right? That's like TikTok. Like I want to watch something. Then you got YouTube and YouTube Shorts. That's like I want my kind of news stuff, updated stuff. But YouTube, you're not going to go to watch like Squid Game. Like who's going to create that on YouTube, right? That's kind of a different sphere. And I think that stuff's going to remain on Netflix, on HBO. I think Apple TV and Amazon Prime. I think it will have a role to play because the amount of entertainment people want is immense. And these platforms are the ones providing it the best. Like Netflix is, the leading direct, no advertisement, direct to consumer, ubiquitous streaming service. YouTube is all user generated content, extremely high quality. It can support people financially to be able to do it full time. Yeah. And then I think other companies, I think big tech is being very much, I think they're like sleepers right now in content. I think Apple will blow away people with the content they'll come out with. Knowing the company, they start off small. They'll come out with stuff that will lower their churn rate and be a real competitive threat. And I think Amazon's already kind of doing that. So yeah, I'm bullish on all of them, I guess is what I'm saying, but for different reasons.
Got it. All right. Thank you so much, Joseph Carlson. You gave us a lot of wisdom in this hour. I think people are going to love it. I mean, you because I know your story fund and how much you think about content in big tech, it was just awesome to pick your brain and really get an understanding of kind of how you see this industry.
Yeah.
So thank you so much for being on. I appreciate it a ton.
Thanks for having me. Appreciate it.